Hey everyone, what's really going on with BigBear.ai stock right now? Is this just a small dip? Or a warning sign investors shouldn't ignore? Let's break it down in a simple way so you can understand exactly what's happening and what could come next. In the most recent trading session, BigBear.ai Holdings Inc. ended the day at $3.75, slipping slightly by just over 1%. Now that might not sound like a huge drop, but here's where it gets interesting: the broader market actually moved up on the same day. For example, the S&P 500 gained around 0.26%, while the Dow Jones Industrial Average climbed 0.24%, and the tech-heavy Nasdaq Composite performed even better, rising about 0.36%. So while the overall market showed strength, BigBear.ai moved in the opposite direction, and that's something investors always pay attention to. Now zooming out a bit, if we look at the past month, the stock has slightly declined by around 0.26%. Again, not a massive drop. But here's the key point: it underperformed its sector. The broader computer and technology sector surged by more than 9% during the same period, and even the S&P 500 gained nearly 6%. That means BigBear.ai is lagging behind both its industry and the general market. Now, all eyes are turning toward the company's upcoming earnings report because this could be a major turning point. Analysts are currently expecting BigBear.ai to report an earnings per share of negative 0.06. But here's the twist that would actually represent about a 40% improvement compared to the same quarter last year. So even though the company is still not profitable, it is improving, and that's something growth investors tend to focus on. On the revenue side, expectations are a bit weaker. Forecasts suggest the company could generate around $31 million in revenue, which would actually be a decline of about 10% year over year. So we've got a mixed picture here: improving earnings efficiency, but declining top-line revenue. Looking at the bigger picture for the full year, projections show BigBear.ai could report a loss of around 0.30 per share. That would still be negative, but it represents a significant improvement of over 60% compared to last year. Revenue, on the other hand, is expected to grow to roughly $143 million, marking a double-digit increase year over year. So overall, analysts are expecting better efficiency and growth, even if profitability hasn't arrived yet. Now here's something many investors overlook, but it's extremely important: analyst estimate revisions. When analysts update their forecasts, it often reflects the latest business trends. If estimates go up, it usually signals confidence. If they drop, it can be a warning sign. In BigBear.ai's case, estimates have remained unchanged over the past 30 days, which suggests a neutral outlook for now. This ties directly into the Zacks investment research ranking system, which evaluates stocks based on these estimate changes. The system ranks stocks from 1 strong buy to 5 strong sell. Historically, top-ranked stocks have delivered impressive long-term returns. Right now, BigBear.ai holds a Zacks rank of 3, which basically means hold. In simple terms, analysts are saying, wait and watch. BigBear.ai operates in the IT services industry, which falls under the broader technology sector. Currently, this industry is ranked in the top 32% of all industries, based on performance metrics. And here's an interesting insight: historically, top-ranked industries tend to outperform lower-ranked ones by a ratio of 2 to 1. So being in a stronger industry could still work in BigBear.ai's favor moving forward. So where does that leave us? BigBear.ai is showing some signs of improvement, especially in earnings efficiency, but at the same time, it's underperforming the market and facing revenue pressure. With earnings just around the corner, the next report could be a major catalyst, either pushing the stock higher or raising more concerns. The real question is this a temporary slowdown or something bigger? This is not finance advice.